Did you know that your money in the bank is insured by a special agency called the FDIC? If you're new to the financial world, you might not know that the FDIC plays a crucial role in keeping your hard-earned cash safe and sound. If you're curious about how banks keep your money safe or wondering what would happen if your bank went under, stick around because we've got you covered. So, what is the FDIC and how do they insure your money? Desperate times call for desperate measures, right? Well, desperate times were the primary cause for starting the FDIC in the first place. The Federal Deposit Insurance Corporation, or FDIC, was created in 1933 in response to the 9,000 bank failures during the Great Depression. During this time, banks were failing left and right, leaving depositors without any recourse or hope of recovering nearly $7 billion in assets. The government realized that something needed to be done to restore faith in the banking system and protect people's hard-earned money. That's where the FDIC came in. Its purpose was to restore public confidence in the banking system by providing insurance protection for deposits in banks and savings institutions. Since its inception in 1933, the FDIC has been a virtual safeguard for American savers, providing them with peace of mind and protecting their money in times of economic turmoil. So, while it's not a perfect system, you could say the problem of recovering depositors' assets from failing institutions has been largely averted. The whole point of the FDIC is to reassure you that you will get your money back, at least some of it, if anything were to happen to your bank. The FDIC was designed to provide a safety net for depositors by insuring their deposits. But unsurprisingly, there is a catch. Depositors are only insured up to a certain amount in case a bank were to fail. Currently, the FDIC insures deposits up to $250,000 per depositor per insured bank. This means that if a depositor has accounts at multiple banks, they can be insured up to $250,000 at each of those banks. This insurance is funded through premiums paid by the banks themselves and backed by the full faith and credit of the United States government. The backstop is intended to provide peace of mind to depositors and maintain stability in the banking system. What do you think about this $250,000 insurance cap? Tell us in the comments. The FDIC plays a crucial role in protecting the money of bank customers. But have you ever wondered who pays for this protection? Is it your taxes? Or hidden fees in your banking services? The answer lies in its agreements with the banks themselves. The FDIC as an agency is not funded by taxpayer money. Instead, the agency is funded by premiums paid by banks and savings institutions. The amount of the premium is based on the level of risk posed by the institution, with riskier institutions paying higher premiums. This funding model has helped ensure the stability and independence of the FDIC over the years, allowing it to continue its important work of protecting American savers and promoting a healthy banking system. Have you ever wondered what happens when a bank goes under? Of course, besides the images of angry customers shaking their fists in the air and the chaos that follows, what really happens and who cleans up the problem? You guessed it, it's the FDIC. Since its inception, the FDIC has taken over more than 3,500 failed banks and savings institutions. In the event of a bank failure, the FDIC has the authority to take over the bank and sell its assets to another financial institution. This process is known as a purchase and assumption transaction, and it is designed to protect depositors and maintain stability in the banking system. The FDIC will typically seek out another bank to acquire the failed bank's assets and assume its liabilities, including its insured deposits. This ensures that depositors are able to access their funds without interruption and helps maintain confidence in the banking system. Deposits Insurance Fund. What sort of backup insurance would the FDIC be if it didn't have a reserve fund? One of the key responsibilities of the FDIC is to maintain a reserve fund that can be used to pay out insurance claims in the event of bank failures. This fund, called the Deposit Insurance Fund, or DIF, is a rainy day fund that the FDIC can draw from to reimburse depositors for losses when an insured bank fails. The reserve fund is built up over time through premiums paid by banks as well as through interest earned on investments. On top of that, the DIF is backed by the full faith and credit of the United States government. The FDIC is required by law to maintain the reserve fund at a certain level, which is currently set at 1.35% of insured deposits. This means that the reserve fund would cover all insured deposits in the event of a true bank failure. The reserve fund is a critical part of the FDIC's operation, as it helps ensure the bank customers are protected even in the event of a major financial crisis. As of December 31, 2022, the DIF had a balance of $128.2 billion. This reserve fund is intended to be sufficient to cover any losses incurred by the FDIC in resolving failed banks. They say rats can smell cheese from a mile away. And when it comes to the FDIC, it's designed to spot a failing bank a mile away. When a bank fails, it can cause a chain reaction or contagion that affects not only that bank's customers, but also other banks and the broader economy. When customers lose faith in one bank, they may start to worry about the safety of their deposits in other banks, causing them to withdraw their money or shift it to a more stable financial institution. As part of its mission to maintain the banking system's stability, the FDIC is responsible for identifying banks at risk of failure. This means that even before the bank descends into failure, the FDIC probably already saw it coming. They use a number of different tools, including on-site examinations, financial analysis, and other methods in their prediction of patterns that lead banks towards a spot on the FDIC problem bank list. The goal of this process is to confidently identify banks that are experiencing financial difficulties and to work with them to develop a plan for improving their financial health. In some cases, when these rescue plans don't work out, the FDIC may take a more drastic action, such as seizing control of a bank and either selling it or liquidating its assets. By identifying banks that are at risk of failure early on, the FDIC can help prevent these failures from causing widespread damage to the economy and to bank customers. Prevention, as they say, is better than a cure, and the FDIC agrees. So now that we've scratched the surface on protecting your bank account, are you certain that your bank is FDIC insured? If they're not, will you move your funds to an FDIC insured bank? We can't tell you what to do, and frankly, that's none of our business. But if you want to learn more about banking or personal finance, stay tuned for our next video.